Major U.S. averages soared today as the Dow breached record highs. Now, Keith, what's the logical explanation for this? Is it just Fed stimulus or is it something else?
Well, a lot of the things that we look at inside of the market, we've been seeing some trends, some intermarket trends that have broken down. So we're actually quite surprised by this move. So the other thing I can point back to is Fed stimulus. That's the major reason. The other things you can pull out is at the end of the day, we've gotten most of the S&P 500 companies have reported their fourth quarter earnings, and they've exceeded earnings analyst estimates on both EPS and revenues. So that's been a good picture. Even though broader sales have been down, it's not an end of the world scenario. So we got the combination of those two things. People like what's happening. Also, don't bear in mind, and a lot of this happens because of what's been going on with the Fed and the monetary authorities around the globe. The only place you can find yield right now is the equity market. So we got a lot of money coming in here and chasing this, and they're chasing it right now.
So the big question, of course, is can we go higher from here?
Well, now we're on a technical trade. The fundamentals have played out in our mind. We're on a technical trade, and we, as you were saying, we got to an all-time high. So on both the Dow and the S&P, we've crossed through some pretty strong resistance levels that we had lower. The S&P is definitely going to move up from here, we think. Once it got above 1530 and that level, if it can close up there, which it looks like it's going to, I don't see any reason why it wouldn't get back to an all-time high at 1565. But the other thing to bear in mind, what's interesting about this move is the move is being led by traditionally defensive types of stocks. Dividend payers, utilities, stocks that you would see when the market is starting to sell off, stocks that you would see that would rally up. So that's the other thing, gives us a little bit pause for thought here. We're not too convinced that people are really all that excited about this rally and this high that we're getting here. And you're kind of seeing it. It's kind of quiet in here. The volumes are not really piling in like you would see by hitting all-time highs.
So we need to exercise some caution from here.
Absolutely. Unfortunately, I've been a little wrong the last week. I thought we were going to pull back sooner than we did, but I think once the S&P gets up to its all-time high, I absolutely would exercise some caution, take profits off the table. Everybody should have profits when the S&P gets to an all-time high, and then really reevaluate where you're going to get there. Again, I think there's a lot of intermarket trends that have broken down. We should see bond yields much higher than they are. We should see items like the tips rallying hard here. If people thought there was an inflationary pulse inside of the market, we're not seeing that. It's actually selling off. We should see utilities pulling back and other defensive names pulling back. They're not, they're leading. So again, it's those intermarket trends that really make me cautious here. I think we'll push the all-time highs, but at that point, I really reevaluate and I step to the sideline.
So over the past week, given the strong technicals, the markets have largely shrugged off negative headlines. But this time around, I mean, what do you think? How do you think the markets are going to react to this Friday's jobs report?
If we get a good jobs report, we're going to rally up and we're going to get the S&P up to that all-time high. If we get a bad jobs report, and I don't think anybody's expecting a blowout jobs report. I think the consensus is around 150,000 new jobs with the unemployment rate holding steady around 7.8, 7.9%. That's certainly not enough to get a GDP level up to 3.5% and 4%, get the consumer off its back or where it is right now. And by the way, the consumer is starting to get stretched a little bit because of higher gas prices, higher taxes that have kicked in. We'll see how that plays out in the next 2 to 3 months. But anyway, the catalyst, for me, that is a catalyst that we'll see. The opening acts for that catalyst will start tomorrow with the ADP report, and then we'll get the continuing claims and the new jobless claims, and then the big number on Friday. Any weakness in that number, I think that'll give the market an excuse to pull back a little bit here.
And also today, the VIX leveled off a bit. How are traders handling or dealing with the lack of volatility, and what do you expect could be the next catalyst for a spike in volatility?
It's difficult to trade this market, quite candidly, when you see the slow grind higher with little volume and volatility has been sucked out of it. It's actually more difficult to gauge where it's going to go, and I think that's why a lot of traders are on the wrong side of this move. Some of what you're seeing today is a bit of a short squeeze that's happening because almost everybody in the market have thought that this thing is overbought and it's overextended at this point in time. We bring more volatility back in the market. You'll certainly see more volumes. You'll see, actually, I think you'll get back to a little bit more reliable trading patterns, and the intermarket trends will start to come back into an alignment of what we see, and then it'll be easier to trade. But for right now, the lack of volatility, the lack of volume, it's making this market very difficult to trade. Although you could have said just buy spiders on January 3rd, 2012, and you'd be up 26% right now. That would have been the best trade of all.
Thanks, Keith. This is Andrea Say reporting for The Street.